A monumental shift is underway in global finance. The world's two largest economies are quietly redrawing the lines of economic power, and the consequences could be felt for decades to come. For decades, China was a top foreign buyer of American assets, helping fund U.S. spending and cementing the dollar's dominance. This relationship was a cornerstone of the global financial system, with China's vast reserves flowing into U.S. treasuries and stocks, supporting American growth and stability. Now, that trend has reversed. China is systematically selling off its American holdings, marking a dramatic change in strategy that is sending ripples through international markets. This is not a minor adjustment. It's a deliberate long-term strategy to reduce exposure to the U.S. and to insulate China from potential economic or political shocks originating from Washington. China's U.S. Treasury holdings, once at $1.3 trillion in 2013, have plunged to a 17-year low of $682 billion by 2025. This steady decline reflects a fundamental shift in how China manages its wealth and risk. That's a reduction of over $600 billion, signaling a clear move away from American debt. The scale of this divestment is unprecedented, and it's raising alarms among economists and policymakers alike. The sell-off extends beyond bonds. Chinese investors are also dumping U.S. stocks, creating what analysts call a sell America trade. This broad retreat is reshaping the landscape of global investment. In a single month in 2024, China sold a record $42 billion in U.S. stocks and bonds. The speed and scale of these sales have caught many on Wall Street off guard. In just 5 months, total divestment hit nearly $80 billion. This rapid withdrawal is forcing global investors to rethink their strategies and risk assessments. Experts warn that a full financial decoupling could see China liquidate all remaining treasuries and hundreds of billions in equities, shaking global markets. Such a move could trigger higher U.S. borrowing costs and increased volatility worldwide. Other countries are watching closely, with some central banks already considering similar diversification strategies to reduce their own reliance on the U.S. dollar. China's trade surplus, now over $1 trillion, is no longer recycled into U.S. assets. Instead, those funds are being redirected into new markets and alternative investments. Instead, China is actively seeking alternatives, diversifying its reserves, and reducing its dependence on the U.S. economy. Gold, euros, and other assets are becoming more prominent in China's portfolio. This is a conscious pivot to build a more independent financial future. Chinese policymakers are determined to shield their economy from external shocks and to assert greater control over their financial destiny. The implications are profound, a new chapter in U.S.-China economic relations, with ripple effects for investors and governments worldwide. The global order is being rewritten in real time. China's strategy is clear: reduce vulnerability to U.S. policies and pressures. This is about economic security as much as financial returns. The era of China as America's banker is ending. A new era of financial independence and competition is beginning. The world is watching as the financial balance of power shifts. Every move is scrutinized, every headline analyzed for clues about what the future holds. The question now: what comes next? As China rewrites the rules, the global economy stands at a crossroads, facing uncertainty and opportunity in equal measure. As China sells U.S. assets, it's not just making a financial adjustment, it's signaling a major transformation in its global strategy. The world's second-largest economy is actively reducing its exposure to the U.S. dollar, a move that has far-reaching implications for international markets and global power dynamics. Instead, China is making a bold move, buying gold at an unprecedented pace, shifting its reserves into something universally recognized and historically resilient. The People's Bank of China has been on a gold buying spree, adding to its reserves for 14 consecutive months. This consistent accumulation signals a clear, long-term commitment to gold as a core asset. Officially, China holds over 2,300 metric tons of gold. But many analysts believe the real figure could be more than double, as not all purchases are publicly reported. Gold now makes up over 9% of China's reserves, a historic high that marks a significant shift from previous decades. China's demand accounts for a quarter of global gold purchases, driving prices higher and influencing the entire gold market worldwide. This isn't just about diversification, it's a calculated geopolitical maneuver reflecting China's desire to reduce vulnerability to US financial policies and sanctions. Every treasury bond sold and every gold bar bought is a step toward greater economic sovereignty and independence from Western influence. China is rebalancing its portfolio, moving away from US-controlled assets to something tangible and neutral, gold, which has stood the test of time as a store of value. The shift from dollars to gold is reshaping global finance, challenging the dominance of the US dollar and prompting other nations to reconsider their own reserve strategies. China is betting on gold as the foundation for a more secure and stable future, both for its economy and its people. The world is taking notice, watching closely as China's gold strategy sends ripples through the global financial system. Why gold? For China, it's about security. The freezing of Russia's reserves in 2022 showed that dollar assets can be weaponized. Gold stored in Beijing can't be frozen by foreign powers. By converting dollars to gold, China is building sanction-proof wealth and reducing risk. A large gold reserve also boosts confidence in the yuan, supporting its push as a global trade currency. Gold is both insurance and a tool for China's financial ambitions. China isn't just selling US assets, it's building a new financial system. The Cross-Border Interbank Payment System, CIPS, is China's answer to SWIFT, enabling global payments in yuan. By 2025, CIPS connected nearly 1,500 institutions in 119 countries, growing rapidly. Alongside CIPS, the Belt and Road Initiative and the New Development Bank are driving yuan adoption and local currency lending. These efforts create a closed-loop system, strengthening the yuan's international role. China is laying the groundwork for a parallel financial world, independent of the dollar. The global financial landscape is changing fast. China's new financial system is transforming global trade. More deals are settled in local currencies, bypassing the dollar. China and Brazil now trade soybeans and iron ore in yuan and reais. Similar moves are underway with other major partners, including talks with Saudi Arabia to price oil in yuan. Belt and road projects are increasingly contracted in yuan, expanding its reach. As more countries use the yuan, the dollar's dominance erodes. Trade corridors are shifting, making China's network more resilient to US pressure. Strategic decoupling is happening, one transaction at a time. China's recent financial maneuvers are putting unprecedented pressure on US markets and the dollar, sending shockwaves through Wall Street and beyond. As China sells off US treasuries at a rapid pace, America's borrowing costs are climbing, clearly visible in the sharp 20,000 SAO spike in 10-year yields. This makes it more expensive for the US government to finance its debt, and the effects ripple through the entire economy. The dollar's share of global reserves has now dropped to a 30-year low, as more countries diversify away from the greenback and seek alternatives for their reserves. The dollar index fell nearly 10% in 2025, making imports costlier for American consumers and fueling a new wave of inflation that's hitting households and businesses alike. US companies, especially those with deep ties to China, are seeing falling sales and shrinking investment as Chinese investors pull out, leaving some industries struggling to adapt. Stock prices are under heavy pressure, and the old safety net, where bonds would rise when stocks fell, has broken down, leaving investors with fewer places to hide. In 2025, stocks and bonds fell together multiple times, upending traditional risk management strategies and forcing investors to rethink how they protect their portfolios. The US is feeling the full impact of China's financial pivot, as Beijing's new strategy reshapes the global economic landscape and challenges American dominance. The era of easy money and unquestioned dollar supremacy is now under threat, raising concerns about America's future role in the world economy. Investors are navigating a new, more volatile landscape, where old assumptions no longer hold, and uncertainty is the new normal. The global market dynamic has fundamentally changed, with financial flows shifting and volatility becoming a constant challenge for economies everywhere. The question now is, how will the US adapt to this new reality? The world is watching closely, waiting to see America's next move. As faith in paper currencies fades, gold is surging. China's massive gold buying has pushed prices to record highs, over $3,900 an ounce in 2025. Analysts predict gold could reach $5,000 as de-dollarization accelerates. Central banks worldwide are buying gold at the fastest pace since the 1960s, outpacing treasury purchases. Emerging markets are leading the charge, seeking independence from U.S. monetary policy. A weaker dollar boosts their economies and makes their markets more attractive. Gold is re-emerging as a core reserve asset, not just an inflation hedge. The world is moving toward a more multipolar gold-anchored system. The future of money is being rewritten. Gold's golden moment has arrived. China's divestment, gold accumulation, and new financial infrastructure are reshaping the global order. The era of unquestioned dollar supremacy is ending. We're entering a multipolar world where several currencies and assets compete. The yuan will dominate in Asia and Belt and Road countries. The euro and others will rise regionally. This brings both complexity and opportunity, more currency risk, but less dependence on any one nation. For the US, losing reserve currency status means higher borrowing costs and tough fiscal choices. The global economic center is shifting eastward, and gold is the new anchor of trust. Understanding this shift is crucial for investors and policymakers alike. China's strategy is redrawing the financial map. The consequences will shape the world for decades to come.